بسم الله الرحمن الرحيم. أول شيء نحكي لكم كل عام وانتم بخير بمناسبة عيد الأضحى المبارك، وإن شاء الله يعني ربنا سبحانه وتعالى يعيده علينا بالخير وعلى الأمة الإسلامية إن شاء الله والأمة العربية وكل شعوب العالم إن شاء الله. المرة اللي فاتت كنا نحكي بالliquidity management or the liquidity ratios, and we categorize liquidity into general liquidity management and individual asset categories. So we measure the liquidity in general, and we measure the liquidity of each item in the current assets. Generally speaking, the liquidity is measured by two main ratios. The first one is the current ratio, and the second one is the asset ratio. And we say the asset test is much or more important than the current ratio. Now we will talk about the liquidity ratios in terms of individual asset categories. Okay, we will see the asset or the account receivable turnover and the inventory turnover. The importance of these two items, the account receivable and the inventory, it has direct impact on the cash. So it means if we have efficient management to the account receivable and the inventory, it's generated more cash. Let's see to the account receivable. The account receivable turnover is related to how long it takes to convert account receivable into cash. In terms of how many times that we can convert account receivable into cash in a year. And the same thing when we talk about the inventory, how long it takes from us to convert inventory into cash. This is the important. So, and the account receivable is measured by the average collection period, how long it takes to convert the account receivable into cash. We divided the account receivable by the annual credit sales. So annual credit sales is the daily credit sales. How we can get this? Annual credit sales divided by 365 days. So we get account receivable divided by the daily credit sales. So the answer is in days. So if we have less days, is much better than having higher days. Let's, for instance, if the average collection period, collection period is 9 days for company A. For company A is 9 days, and for company B is 27 days. So it means company A has shorter collecting periods, which is indicate company A may have more liquidity than company B. Okay, in some cases, people calculate the account receivable by the account receivable turnover. Instead of using average collection periods, they are using account receivable turnover. How they do this? It divided the account receivable by the annual credit sales. Sorry? Annual credit sales? Annual credit sales or credit sales by the account receivable. So the result is in times. The results will be in times. So according to this account receivable turnover, how many times that the business convert the account receivable into cash? And we expect that the business have hiring times than the other business. For instance, if still we have company A and company B, if company A has 30 times and company B have 15 times, it means this A takes 13 times to convert asset into cash. So if you convert this into days, you just need to do like 360 divided by 30 times, you get the number of days. You can do it in different ways. Sorry? No, this is 30 times a year. You convert the asset, you convert account receivable into cash 30 times a year. Now I'm asking you, which 30 or 15? Yes, 30 times is much better than 15 times. Okay. This is how we calculate the daily credit sales, 2,500 divided by 365 days. Account receivable divided by daily credit sales. So this is the account receivable divided by daily credit sales. You have 20 days. So it takes 20 days to convert the account receivable into cash. You can compare this with the peer group or with the industrial level and then judge on this results. And this is account receivable turnover. This is calculated based on times. This is calculated based on number of days. And this is calculated by the times. And again, it's annual credit sales divided by the account receivable. And the result is in times, 17 times. It takes, or the account receivable is covered 17 times, or liquidated 17 times a year in the business. Okay. Now we will talk about the inventory turnover. The inventory turnover is, again, how many times we convert inventory into cash. How we calculate this: cost of goods sold divided by the inventory. And go back to the income statement and the balance sheet of the Baswell company. You have the cost of goods is 1,980 divided by 229. So you have 8.63 times. It means we converted inventory into cash 8.63 times a year. If you want to convert into days, you just do like 360 or 65 divided by 8.63, you get the number of days. Okay? And we expect the higher inventory turnover, the most efficient or most liquid, the more the business is liquid. Okay? Peer group. Peer group is like you compare yourself with the industry or with the competitors. Yes. No, this is your competitors. The peer group is your competitors. You comparing this 8.63, for instance, this 8.63 with the peer group, and the inventory is 8.63 times. If the peer group is 9 or 11, it means we have problems in the inventory, because the peer group is higher in terms converting inventory into cash than the Baswell company. We will go back in details about the inventory turnover when we talk about the asset efficiency or the management of the asset efficiency. In terms of the number of days, as I did, 365 divided by 8.63, so we need 42 days to convert inventory into cash. So the cycle is going like this. This is inventory. Then we convert inventory into sales. Then sales into cash. So it takes around 42 days to convert inventory into cash. This time is around 42 days. Okay? So around 1 month and a half. 42 days. Can firm have too much liquidity? Yes. Is good for business having too much liquidity? No. Why no? Yes, because they are missing the opportunity for investments. So the question is, having too much liquidity is good for business or not? No. Why? Missing the opportunity for investments. Let's go to the checkpoints. This is checkpoints summarizing the accounts of Dell, Apple, and HP. And these three companies are working in the computer or let's say software, hardware industries. So UPOS has asked that you look into Dell's liquidity. So we should look at the Dell liquidity and analyze its ability to pay their bills on time using the following accounting information. And we will compare the Dell with the other companies, Apple and HP. So you have these accounts, the current assets, account receivable, cash, inventories, sales, cost of goods sold, and the total current liabilities. If you do the calculations, the current assets, look at the current assets, or the current ratio here is 1.63, and the average is the average of Apple and HP. You get 1.75. We can judge on this that the Dell having lower liquidity ratio, so it's bad. Having lower liquidity ratio than the peer group, if you compare the Dell with the average ratio. For the asset test, however, the asset test is fine because it is above the 1, but comparing with the peer group, so you have 1.56 and here 1.65. Still, the average is greater than the Dell, so still you have bad ratio comparing with the. But if you judge on this just by itself, you see it's fine. I mean, without looking at the HP or Apple, because it is greater than 1. 1 is fine. The asset test, if it is the asset test 1, so it's good for the business. Now look at the account receivable turnover. So the account receivable is 7.15 times a year, and here is 6 times a year. So here is much better than the average, let's say is good. So the account receivable is more efficient than the average of HP and Apple. If we look at the inventory turnover, it is 47, and here is 33 times. Still, the inventory turnover is much better. Now, we have two results. The current ratio and the asset test have bad results, and the account receivable and turnover have good results. So this needs further understanding to see what is the problem of having ratios below the average. So it needs to more in discussion the accounts. Go back to the checkpoints and try to think, where is the problem? Maybe the problem in the cost of goods sold, maybe the problem in the cash itself. So try to think and to judge on in the issues. Now we will move to the capital structure ratios. Capital structure ratios. The capital structure ratios, it measures to what extent business depends on debts, or how much they use debts and how much they use equity. So as I said, financial decision is related to to the two parts of the liabilities. The first one, you are using the long-term liabilities, which is debts, or you are using the equity. This is in terms of the capital structure. It's just to remind you with the T account, here is the current assets and here is the fixed assets, which end with the total assets. Now here is short-term liabilities or the current liabilities, and we have long-term liabilities. This part is known as total liabilities. And total liabilities considered as a debt. And here is the equity. Now the question is whether the business is using total liabilities or debt or equity. What is the structure of finance? From where they are financing the assets? From the total liabilities or from the equity? Or mixing between the debts and equity? What is the best structure for the business? The best structure for the business that generates more income, or the maximizing the value of the business. So this is our decision when we ask you what is the best for the business. The best of the business that the decision maximize the value of the business. We cannot say 50% is much better for the business. We cannot say 60 or 70. So it depends on to what extent the capital structure, this is the optimal capital structure, maximize the value of the firms. This is the decision. So the capital structure, again, refers to the way a firm finances its assets. How we can measure this? There are many ratios. We can measure this. Well, the most important ratios are the debt ratio and the time interest in ratio. So the first one, which is the debt ratio, is calculated as the total liabilities divided by the total assets. So look at this part divided by this part, the total assets. So in other words, from where we finance the total assets, or how much we are using debts to finance the total assets. So we can apply this equation by total liabilities divided by the total assets. And when we do this, we have 1012.50 divided by 1764. We have the result is 57.40%. What this means? So the result is around 57%. What this means? What the 57% means?
It means that 50% of our assets is financed from debts.
Yes, from the debts. What is the debts?
The total liabilities.
Total liability. What is the total liabilities? Short-term liabilities and long-term liabilities. Because why I'm asking this? Because some questions are not directly answered. For instance, I give you the assets, the total assets, and I give you the equity. Then I ignore what is the liabilities. If I give you the short-term liabilities, so by using this equation, you can give or the long-term liabilities. Okay, the assets, then the total liability is equal the assets minus the equity. Now, the total liability, if you know the total liabilities, so, and you know the short-term liabilities, you can easily know the long-term liabilities. So this is why I'm trying to track your answers. So this is the debts. Then you go till you take off the short-term liabilities and long-term liabilities from the equation. Okay, so my question is now, is more than half of the total assets is financed from the debts? Do you think this is risk for the business? Yes, because more than 50% of the assets is financed. It means the other half is the markup is financed by equity. Okay? So around the 34% or 43% is financed by equity. Okay, any question in this ratio? There are many other ratios related to but we're focusing on here on the most important ratios. The second ratio is the time interest earned. This measured how many times that the business covers the interest expense. And it's measured by dividing the operating income by the interest expense. And the outcome is number of times. And you see here is 5.38 times. What this means, it means the interest expense, or the operating income covers the interest expense by 5.8 times. In other words, we can put in different ways. Just divided by 5.38. Do it. 1 divided by 5.38 is around 13%, 14%. 18%. Yes? Just divided 1 divided by 5.38. How? So 18%. What this means, it means the interest expense represents 18% from the operating income. Represent 18% from the operating income. For instance, if you have $100 as operating incomes, of them $18 as interest payments. Okay. 18%, it means the interest payments or the interest expense represent 18% from the operating income. In other words, if you have operating income $100, of them $18 you have to pay them as interest expense. Now think on this way. If 5.38 times is going up, for instance, if the peer group is 9 times, what do you think? This is much better for the business, or what do you think? Having 9 times or having 5 times, which is good for business? 5 times. Okay. Let's agree with you that 5 times is much better than this. Good. Do it in different way. Let's think in different way. Okay, so we divided 5.38 divide حكينا على 5.38 times. So the time interest earned, it means how many times the operating income covers the interest expenses. Okay. So we prefer this to be high for the business. Okay. This is checkpoints helping you how to understand the capital structure ratios. If you read this example here, is you have the total debts for Home Depot and Louis. You have total common equity, you have total assets, operating income, and interest expenses. What you are going to do is to calculate the debt ratios and the times interest earned. After calculation this, you have the debt ratio is 52%. In Dupont and Louis is 43%. It means the debt ratio in in Dupont is higher than the Lewis. The time interest here is 24, and in Lewis is 33. What it means then? What it means the 24 for Dupont and 33 for Lewis. The times interest earned, and which is preferable. 33. Okay, what it means 33 here?
Yeah, how much interest from my income I pay for the loans, the interest from the loans.
But again, say it again.
The interest that I pay for the loans,
How much interest?
How much
You mean
time?
how much times?
Turnover.
Yes, time.
No.
Interest as a percent from the operating.
Look at this 33 here. 33. This is not interest. Times. What it means, exactly what it means. Say it again. How many times?
How many times per the year I pay interest to my
No.
How much the operating income cover from the interest?
Yes. So this is different things. We may give you like true or false, and we will say this is what you say is false. But what she said is true. So how many times that the operating income covers the interest expense? Okay? So be careful in how you're perceiving the ratios. Okay? And this is the solution of the capital structure example. Now we will talk about the asset management efficiency ratios. Asset management efficiency ratios. What it means, asset management efficiency ratios. Asset management efficiency ratios measure a firm's effectiveness in utilizing its asset to generate sales. The big question for this is to what extent the assets, which includes the total asset and fixed asset, generate or producing sales. So the more the asset generates sales is the more efficient the business. So we can cover this by using the turnover ratios of the assets, of the total assets and for the fixed assets. The first one, total asset turnover ratio, is equal sales divided by the total assets. So you have 2.7 million divided by 190.71. So you have 1.37. What it means $1 invested in the total assets generate 1.37 sales, or $1 in sales. If you compare this one with the peer group, you see our company is much better than the peer group. Okay. Just to bear your mind in terms of your assignments, how we can calculate the peer group. The peer group is the average of the industry. So be careful when you are writing your assignment on this. And inshallah, after the mid-exam, I will arrange a meeting for you to train you how to write your assignment, or how to write the academic assignment. Okay. For the year of 2009. The total asset turnover ratio for 2000, if we assume that the total sales were 2,500, so what will be the results? Fixed asset. Now we will talk about the turnover of the fixed asset. Fixed asset turnover, which equal the fixed asset divided by the sales divided by the fixed assets. From where we can get the fixed assets? The fixed asset is coming from total asset, the fixed asset minus the depreciation. So we get the net fixed asset. Okay? So be careful when you are calculating the net fixed asset. So it's equal the fixed asset minus the depreciation. So we get in 2009 1.94 1.94, it means $1 invested in the fixed asset generates 1.94 as sales. Okay, so put them together, you have total asset turnover 1.37, fixed asset turnover you have 2.03. This is for the company. Now we'll talk about the other two ratios of the turnover or the management efficiency: the receivable turnover and the inventory turnover. Receivable turnover and inventory turnover. Receivable turnover measures to what extent or how long it takes from the business to convert account receivable into cash, or what is the collection period of the account receivable. Okay, how we can calculate this? Receivable turnover, credit sales divided by account receivable, which is equal 16.67 times. This is in times. If we want to convert this into days, yes, so you can convert by like 365 divided by 16.67, you get the number of days. So the more times you are circulating the account receivable, the less number of days you need to convert account receivable into cash. So say it again. The more time that we have to convert account receivable into cash, the less number of days that we need to convert account receivable into cash. For instance, if company A, the account turnover for the company A is 17 times, and for company B is 15 times.
17.
So we prefer A, or A has more efficient collection than company B. It means company A has less days to convert account receivable into cash. How we can calculate this? Just 365 divided by 17, and here 365 divided by 15. What is the number of days here? 21 days and 24 days. So we need here 21 days to convert account receivable into cash, but here we need 24 days to convert account receivable into cash. Now for the inventory turnover, the same things. It can calculated by the cost of goods sold divided by inventories. And this is measures how long it takes or how many times we can cycle or convert the assets into, the inventory into cash. So in this example here, in this company, it takes 3.36 times. In terms of the number of days, just divided 365 divided by 3.36. And we need around 90 to 93 days to 109 days to convert inventory into cash or to turn over the inventory. Okay, to turn over the inventory. Okay? So, put all of the results together. The turnover ratios, total assets, we have the fixed asset ratios or turnover, receivable and inventory. This is the Paswell company. The total asset is 1.37, fixed asset turnover 2, 16 and 5. If we compare with the peer group, we just click on the one that we prefer. For this is preferable. The Paswell is preferable, and in terms of fixed asset is preferable too, and in receivable as well. So, but we have problems in inventory turnover. So the total asset is fine, is more efficient than the peer group. The fixed asset also is more efficient than the peer group. And the collection for the receivable is fine as well, but the problem in the turnover of the inventory. So we need to know why this is a problem. Maybe we have inflated inventory. Maybe we pay more money to the inventory. We keep some raw materials, unnecessary raw materials in the stock. We have to think in the inventory methods. We may use inefficient methods in keeping the inventory. Some companies, they are using just-in, other companies using other methods in managing the inventory. So it's fine to focus on the inventory and to improve the situation here. Now we will talk about the profitability ratios. Any question before moving to the profitability ratios? Okay, any question? Okay, the profitability ratios measures to the extent that business generates profits from different areas, from the gross, from the operating, and after paying interest and taxes. And this is the main thing. The second thing, the profitability ratios help us to looking at the cost, or doing like cost control on the expenses. So it addresses very fundamental question: has the firm earned adequate returns on its investments in terms of profit margins, return on investment, or return on equity? So two fundamental determinants of firms' profitability. The first one is the cost control, how we look at the cost, and we know the cost is coming from the cost of goods sold, coming from the operating expenses, coming from the interest and expenses or taxes. This is important to know where is the cost is coming from. Then the efficiency of asset utilization. About how the asset is efficient, how managing the equipment, the machines, the plant in generating the sales. So we are looking for the two main things when we are estimating the profitability ratios: the cost and the efficiency of asset utilization. The first one is the gross profit margin. Gross profit margin is the gross profit divided by sales. And if you calculate this gross profits, 650 million and 2,500, so you have 26%. At 26%, it means $1 in sales generates 26 cents as a gross profit. So it means, in other words, $1 in sales, this is the $1 in sales, 26 cents is gross profits. And 74 is cost of goods. So we think that this is high. If you look at this area is here, it is high because there is a space to consume other expenses, but still this is, comparing with the cost of goods, is low. So it's fine if we think how to improve the cost of goods sold and think how we can manage this. The second one is the operating profit margin, which is calculated as the net profit income divided by the sales. So you have 14.2%. 14.2%, and we know that's 26% the gross profit margin, And now the operating profit margin is 14%. It means my question is how much it costs us the operating expenses in terms of sales. Again, we have 26%, the gross profit margin, and net, let's see, the operating profits margin is 14%. Just look at this and look at this. Why the net profit margin or net operating profit margin dropped to 14%? Yes. Which expenses? You are right. Operating expenses. Do you know how much? 12%. So the operating expenses cost us around 12%. Okay? So when you are analyzing the financial statement or the ratios, look at the two sides. Look at the return and look at how much it costs you to generate the return. Okay? For instance, in this, we need 74% from sales to cover the cost of goods. And the rest is the gross profit. But here, we need 12% to cover the expenses, the operational expenses. Okay? So the two things are important. Comparing with the peer group, it is 15%, which is a bit higher than the business or our business. So it means it's less efficient than the peer group. Okay. For the 2009, if we calculate this for 2009, the operating margin, if we assume sales is 2,500, and net operating income is 350. Just divide 350 by 500, 2,500. You get you get 14%. 14%. Again, it costs, or the operating profit generates 14 cents from the sales. Thus, the firm generates 0.14 in operating profit for each dollar invested in sales. So think, when you are analyzing the profitability ratios, we have the first is 26%, then we have 14%. Then we will see. So this is the gross profit margin, this is the operating margin, and this is the net income margin. The idea is, this is the most important one. Why it is the most important one? Because if the sales fail to generate more gross, it means we don't have room for other expenses. As we maximize this, we can be relaxed in other expenses. Okay? But if we have problems in generating gross, it means we may face challenges in the operating expenses and paying interest and taxes. So this is the most important one. And another important issue, the cost of goods sold is holding the highest cost in the business. Because the business depends on this, in particular in manufacturing business. Now, look at the net profit margin is calculated by net income divided by sales. And is 8.71. It means $1 in sales generates 8.71 cent income as an income. So here we have 8.71%. You see, we have 26, we have 14, we have. So it costs us here around 5%. Okay, 5.30% for interest and taxes. In here, 12% it costs for the operating or operational expenses. And we have 74, don't forget this, 74% for the cost of goods. So we estimate two things in the same time, the return and the cost. We examine two things in the first time. And now we'll talk about, so any question related to the net profit margin, the operating margin, and the gross margin? Any question? Okay. Let's move to the other profitability ratios. And this measures the efficiency of assets in generating sales or generating profits. Operating return on assets. This operating return on assets, it's calculated by net operating income, which is earning before interest and taxes, divided by the total assets. It means the $1 invested in total assets, how much generate as operating income. Okay? Or in other words, how many times the operating income covers the total assets. This is in other words. Let's see this here. What's wrong? Okay. So the net profit margin is net income divided by sales. I think we talk about this. The operating return on assets, as we said in the first slides, it's related to the cost control and asset utilization. Two things. So the operating return on assets, it's combining two things. Combining some items from the income, which measures the efficiency of profits or the profitability ratios, and is coming from the balance sheets, which is measuring the efficiency of assets. So when we talk about operating return on assets, we have the profitability ratios and the cost, the operational, the profitability ratios, and the efficiency ratios. Now look at the operating profits margin is operating income divided by sales. Okay? So this reminding you with the operational margin times the sales divided by the total assets. This is remind you with the asset utilization or asset efficiency. Okay? So now sales goes by sales, this by 1. At the end, you have operating income divided by the total assets. And you have if you have the operating income from the balance, from the income statement, and the total assets from the balance sheets. And you look at the results. Look at the results. We have the operating return on assets, 19%, and for the peer group is 17%. It means the Baswell company is having higher operating return on assets or on sales than the peer group. How we calculated this, how we get the 19%, just go to the operating return on asset is equal operating profit margin, and I showed you how we estimate this. Total asset turnover, so sales divided by total sales, we have 14% times 1.37, and we have the same. Okay? The importance of the importance of this operating return on assets is, as we said, it influences on the profitability ratios or the cost control ratios and the efficiency ratios or asset utilization. So it's important to look at how we can reduce the cost, and as we mentioned before about the inventory, because we observe that the inventory is high in the past world, so we should think. And as we mentioned, when I talk about 74%, it is high, so we should think on the cost of goods sold. So the conclusion is the firm must investigate the cost of goods sold and operating expenses to see if there are opportunities to reduce the cost. But when I observe that it is 26% the gross profits, and it means the markup is 74%, generally speaking, we have a problem in the cost of goods. And this will influence on the return on assets. And it is very clear. And we conclude the other things, return on inventories, because generally speaking, the cost of goods sold has direct impact on the cost of the inventory. So the firm must investigate if it can reduce the size of its inventory. This is checkpoints to evaluate the operating return on asset ratios. You have the account receivable, inventories. So if you have like this, you calculate the account receivable turnover, the inventory turnover, the return on assets, because you have the total assets. You do like these calculations. The operating return on assets, you have the operating profit margin times the total asset turnover, and you have the account receivable turnover, you have the inventory turnover and fixed asset turnover. Just apply the previous equations on this. And then you judge on the results. Look at the results. Take 1 minute to look at the results. The operating return is 18%, 18.55%, 10.65, 10.98, 1.74, 1.60, 27, 29, 291, yes, 4.76, 2.95. Yeah. Okay, let's start by the first one. The operating return on assets is 18.51% in the Home Depot 2007, comparing with Lewis is 18.55%. What do you think about this?
The second is
The second, but there is no significant difference between them. Yes, you are right. We prefer the second. However, no significant differences between the first and the second one. Okay? Look at the second one. Operating profit margin, 10.65%, and we have 10.98%. So what do you think? Khulud, what do you think? The second. But do you think there is big difference between them? No. No difference. Okay, total asset turnover is 1.74 and 1.69. What it means this? It means the assets generate here more sales than the second one. Which means they have more efficiency in terms of managing the assets. But still, the 1.74 is not that big difference between them. Now look at the account receivable turnover. We have 27 and we have 291. I assume there's something wrong with the Lewis. 291. It means every 2 days, every 1 day and a half, they converted the account receivable into cash, which is, we should think twice on this. Inventory turnover, what do you think? Which is, yes, the first one, but still No big difference. 4.76, 4.30. Fixed asset turnover, we have 2.95. The asset utilization here is much better in the first one. The asset utilization, because here fixed asset turnover, it means the equipment, the machines generate 2.95 sales, but in the second one it generates 2.41 as sales. So this is the analysis that we've done, and try to go back to this. And okay, let's talk about the Dupont analysis. The Dupont analysis. The Dupont analysis being generated by Modigliani and Miller. Okay, and this is in particular measure the return on equity. Okay, to estimate this, we are using 3 ratios: 1, 2, and 3. The first one is the profitability ratios. The second one is the efficiency ratios, and the third one is the equity multiplier. We talk about the profitability ratios. We talk about the efficiency ratios, but now the equity multiplier. What it means, the equity multipliers? Yes, 1 divided 1 minus debt ratios. So is 1 divided 1 by debt ratio. And the debt ratio is calculated by the debt divided by the total assets. Or total liabilities and equity. Careful. Okay? Total liabilities and equity. Okay. So now this is the equity multiplier. The more debt ratios that we have, the higher the equity multipliers, or the more equity multipliers. For instance, if the debt ratio is 0, it means we have 1. Equity is starting from 1. And the more debts we have, the more ABS, or firm value. The more in other words, to maximize the firm value of the business, financial managers are maximizing or increasing the debts. And I explained this in financial analysis. Yeah. When we talk about the leverage ratios, we talk about the leverage ratios is like this. We have the stick, and here we have the ball to kick this ball. If this stick, comparing with this, okay, according to the physics, in physics, if we kick this ball will be stronger than this because it is longer than this. So the D, the distance, is longer than the distance of here. Consider the D here is the debts. Okay? And consider the profit. We have the same profit here, and the EBS, also the profit is here, the same profits. So the power is the EBS. The more distance that we have, the more we maximize the EBS. Okay? So the debts is important in business. Let's see as I said about if we have company A and company B. I talked about this yesterday in Excel. In company A, we have the same capital structure. We have 1,000 or 1 million here and 1 million. The debts and the equity. The equity and the share, the bar value is $1. The debts here is 300s or 700s, and the equity is 300. So we have 1 million. Here we have 300s and 700s. Now consider this case, the profit. The profit is, let's see, $100 and here $100. Now let's calculate the EPS for both. The EPS is calculated as the net income divided by the number of shares outstanding. Now, what is the net income here is 100. Number of shares outstanding, if this is bar value, is the 300s. And here is 100 divided by 700. What is the EPS here is 33%. The EPS here is 14%. So in this case, the profit is the same, but what is the difference is the capital structure. Here we depend on more debts. So what is the result? We end with 33% as EPS, and here 14% as EPS. So if we invest $1 in this company, we will generate 33 cents. But if we invest $1 in here, we will generate only 14 cents. So it's fine to invest in A because we maximize the EPS or we maximize the fair value. Why? Because the debts. This is why it's important to include the debts, the equity multiplier, which consider the debts. Okay? So this is why and the more we depend on debts, the more we maximize these. Okay, let's go like this. Change this structure by doing, 100 equity and 900 debts. So we have 100 here. So we get 100% the profits. So if you put $1, you generate $1. What's the profit still is the same. No change in the profits. But the problem of debts, it's maximize the profits and maximize the losing. It's holding higher return and at the same time holding higher risk. If we lose $100, so the idea would change. So we lost here 100 or $1 and we lost just only 14 cents. So we prefer B over A because of the capital structure. Okay? How we calculate the return on equity, just net income divided by sales, sales divided by total assets, 1 divided by 1 minus debt ratios, and we look at the results. This 22% is the result from times 2.16 times 1.37, 7.6%, we have to 22%. Comparing with the peer group, the Maxwell company have higher return on equity. Why? Because net profit, if you look at the total asset turnover is higher, the asset utilization is higher than this. However, the net profit margin is lower than, but what the issue is the equity multiplier, maximizing the value of the business, the return on equity. Okay, so this is the important how finance try to manage the return on equity. Okay, we stop here to talk about the market value ratios next meeting. Okay, this is the last one or the last meeting in the chapter 4. Okay, inshallah, see you inshallah on Wednesday.